Well, the top story this evening, the RBI monetary policy, key policy rates left unchanged. That was the expectation, and this is for the fourth straight time in line with what estimates were suggesting. The Monetary Policy Committee has unanimously decided to keep the repo rate unchanged at 6.5%. 5 of the 6 members voted to maintain the stance at withdrawal of accommodation. However, Governor Shaktikanta said that the RBI may have to consider selling bonds in the open market via auctions in order to keep liquidity tight. He reiterated that liquidity remains skewed in the banking system. On inflation, the Reserve Bank has raised its forecast for the July to September quarter to 6.4%, but the forecast for FY24 and the first quarter of FY25 unchanged at just over 5%. On growth, the MPC has kept the projections for FY24 unchanged at 6.5% despite tightening global financial conditions. The quarter-wise breakup for growth projections also remains unchanged. The RBI also expressed caution over the high growth in some segments of personal loans. Governor Das said RBI is monitoring these loans. However, he did not announce any measures to crimp on such lending.
I would like to emphatically reiterate, let me repeat, I would like to emphatically reiterate that our inflation target is 4% and not 2 to 6%. Our aim is to align inflation to the target on a durable basis while supporting growth. Elevated levels of MSF borrowings amidst substantial funds parked under the standing deposit facility is symptomatic of skewed liquidity distribution in the banking system. Going forward, while remaining nimble, we may have to consider OMO sales, that is open market sales of government securities, to manage liquidity consistent with the stance of monetary policy. Certain components of personal loans are, however, recording very high growth. These are being closely monitored by the Reserve Bank for any signs of incipient stress. Banks and NBFCs would be well advised to strengthen their internal surveillance mechanisms, address the buildup of risks, if any, and institute suitable safeguards in their own interest. The Reserve Bank is closely monitoring the evolving situation and will act proactively to maintain financial stability.
Well, that is the RBI governor. In fact, the governor signaling open market operations to tighten liquidity, and that led to a sharp fall in the bond market. The 10-year bonds got hammered in trade and the yield spiked well beyond 7.3% after signaling open market operations that will drain some liquidity. The rupee, meanwhile, ended flat against the dollar. Lata is standing by now with more on the RBI policy. Lata, a long expected line, status quo as far as rates are concerned, but the big surprise really coming in there as far as the OMOs were concerned.
Well, absolutely. It is ditto as the market expected, and everybody knew they would do something to liquidity. But no one expected such a drastic measure. People were expecting some very severe talking maybe, and maybe something in the form of a CRR hint at some point in time. But no one expected open market sales of bonds, and that has clearly shell-shocked the market. The previous 8 weeks also, the Reserve Bank has been buying on the screen. I mean, they're not announcing an auction. And about 5,000 crores they must have bought. So I specifically asked him, will it be just the screen-based intervention? Every time they buy, they pull out liquidity, right? Because the bankers are giving them money in exchange of the bonds. So when I asked him if it was screen-based, he specifically said, no, we plan to auction. When you auction, you don't buy 5,000 crores over 8 weeks. One auction is 10,000 crore, 20,000 crore. So the market is really sat down after that. And even today's auction, the 10-year, was bid at 7.35. Look at the banker's psyche. Why will I price the yield lower when I know that the Reserve Bank will come and sell bonds at a later date? So give it to me as cheaply as possible, which means at a higher yield. They move in opposite directions. Now, it's possible that the market will find its feet and it won't be that bad because liquidity will return to the market when the government spends money. And therefore, the Reserve Bank may not announce. Suppose a couple of weeks pass with the Reserve Bank not announcing an OMO, maybe you will start seeing some fall in yields. But at the moment, the market's really shell-shocked. Just to add in terms of other macros, why didn't the stock market react? In fact, it gave a thumbs up, whereas the bond market gave a thumbs down. The stock markets are happy that growth has been maintained. More importantly, inflation number, everyone feared after those July-August numbers coming in 7.4 and 6.83, the full year number will be revised higher. It wasn't. And even the year after, they have a fairly benign 4.3 by the end of the year. So market's very happy about that. If it's 4.3 by the end of next fiscal, that is, the Jan-March 2025, 4.3, then you must expect a rate cut in mid-2024 as you prepare towards that period. So the market's pretty cheerful that a rate cut will come, and growth is not sacrificed because it's 6.5% both years, this year and next. So it's strong as far as those who are looking for growth are concerned, like the equity guys, but not for the bond guys who have to reply in the next auction. For them, it's not a good policy.
Well, it is the reason why the bond markets were sulking. Thanks very much, Lata, for joining us. But let's talk about